Most people don't fail at investing because they picked the wrong stock. They fail because they never understood the game they were playing in the first place. And if you don't fix this, it doesn't matter how many strategies, tips, or hot picks you follow. You're going to keep repeating the same cycle of small wins, bigger losses, and longer periods of going nowhere while thinking you're making progress. So let's break down exactly why most investors fail and what actually separates the few who build real wealth from the majority who don't. And the first reason is a lack of a clear strategy because most people entering investing with vague goals like make money or grow wealth without defining a system, timeline, or rules. And without those, every decision becomes emotional and reactive. You buy when things look good, you sell when things feel bad, and that inconsistency destroys your long term returns because investing rewards discipline, not randomness. And the second major issue is time horizon confusion because people say they're investing for the long term but react to the short term moments. And they panic when the market dips and get greedy when it rises. And this mismatch between stated goals and actual behavior leads to constant buying high and selling low, which is the exact opposite of what works. And it happens because most people haven't truly committed to a time frame they can stick to under pressure. Another big reason investors fail is chasing performance because it feels logical to put money into what's already going up. But by the time something is trending, the easy gains are usually gone. And what you're really doing is entering at an elevated price with higher risk. And when momentum slows or reverses, you're left holding something you don't fully understand and didn't originally believe in, which leads to panic selling and losses. Emotional decisions making is probably the biggest silent killer because fear and greed drive most investing mistakes, and fear makes people selling during downturns, locking in losses, while greed makes them overcommit during peaks, exposing them to unnecessary risks. And unless you have a system that removes or reduces emotional influences, you will eventually make decisions that hurt your portfolio regardless of how much knowledge you have. Overconfidence is another trap, especially after early success, because a few good trades can make someone believe they have skills when they were actually benefiting from favorable marketable conditions. And that false confidence leads to larger, riskier decisions that eventually backfire, wiping out gains and sometimes more. And this cycle is incredibly common because people attribute wins to skill and losses to bad luck instead of analyzing what actually happened. The lack of diversification is another critical issue because putting too much money into a small number of assets increases the risk significantly. And while concentration can amplify gains, it also amplifies the losses. And most investors don't have the experience or information needed to manage that level of risky effectively. So they end up exposed to outcomes they can't control. And on the flip side, though, over diversification can also hurt because spreading money too thin across too many investments can dilute returns and make it difficult to track the performance or make meaningful gains. So the key is balance, not extremes, but finding the balance that requires understanding your goals and the risk tolerance, which many people skip entirely. Another reason that some investors fail is ignoring the fees and the costs, because small percentages might seem insignificant in the short term, but they compound over time into substantial amounts that eat into the returns. And whether it's management fees, trading costs, or hidden expenses, these factors can quietly reduce your overall performance without you realizing it. Poor risk management is another major factor because many investors they focus only on potential gains without considering the downside scenarios. And without proper risk controls, a single bad decision can cause significant damage to a portfolio. And recovering from a larger losses requires disappropriately, larger gains, which makes the path forward much harder. The lack of patience is also a huge problem because investing is inherently a long term process. But people want quick results, and when those don't happen, they abandon their strategy or switch approaches repeatedly, which resets progress and prevents compounding from doing its job. And this constant switch often leads to worse outcomes than simply staying consistent with a reasonable plan. The information overload is another hidden issue because we live in a world where there is no shortage of opinions, predictions, and analyzing. And while information can be valuable, too much of it creates confusion and indecision. And many investors end up paralyzed or constantly second guessing their choices because they're trying to process conflicting inputs instead of focusing on a clear strategy. Another key reason is misunderstanding the risk because many people associate risk only with volatility. In reality, risk is the probability of not achieving your financial goals. And avoiding all volatility can actually increase risk if it means your investments don't grow enough over time. So, understanding the difference between short term fluctuations and long term risk is critical for making better decisions. Market timing is another area where most investors fail because trying to predict short-term movements constantly is an extremely difficult, even for professionals. And yet many people attempt it anyways, buying and selling based on predictions that often turn out wrong, and the result is missed opportunities and increased costs that reduce the overall returns. The lack of consistency is another major issue because the successful investing is built on repeated disciplined actions over time, not occasional bursts of activity. And the inconsistent contributions, the irregular investing, and frequent changes in approach all disrupt the compounding process and limiting, long-term growth. Another reason is not having a clear understanding of what you're investing in because many people buy assets based on recommendations or trends without truly understanding how they work, what drives their value, or what risks they carry. And when something goes wrong, they don't have the confidence or knowledge to make informed decisions, which leads to panic and mistakes. Unrealistic expectation also plays a big role because many investors expect high returns with low risk and become disappointed when reality doesn't match those expectations. And this disappointment often leads to abandoning strategies prematurely or chasing riskier opportunities in an attempt to achieve unrealistic goals. Another overlooked factor is the lack of review and adjustment, because investing isn't a set it and forget it process. Forever, it requires periodic evaluation to ensure your strategy still aligns with your goals, risk tolerance, and market conditions. And failing to review your portfolio can lead to drift, where your investments no longer reflect your intended approach. Behavioral bias too also contributes heavily to failure because humans are wired with tendencies like loss aversions, confirmation bias, and hard mentality. And these biases influence decisions in ways that are often counterproductive to successful investing. And unless you actively work to recognize and manage these biases, they will continue to impact your results. So, what actually works? Because knowing why people fail is only useful if you understand what to do instead. It starts with having a clear, defined strategy that includes your goals, time horizons, risk tolerances, and rules for decision making. Because once those are in place, you reduce the influence of emotion and increase the consistency. Focusing on long term investing rather than short term speculation is another key factor because it aligns your actions with the way wealth is actually built over time through compounding and sustained growth rather than quick wins. You know, diversifying appropriately based on your situation, it helps manage risk while still allowing for meaningful returns. And being mindful of costs ensures that more of your gains stay in your portfolio rather than being lost to fees. Consistent investing, even in small amounts, takes advantage of compounding and reduces the impact of market timing because you're spreading your investment over time rather than trying to predict the perfect moment. Educating yourself about what you invest in builds confidence and improves your decision making because you're not relying solely on external opinions and setting realistic expectations. Helps you stay committed to your strategy even when results are slower than you'd like. In regularly reviewing and adjusting your portfolio, it keeps it aligned with your goals while still maintaining a long term perspective. And being aware of behavioral biases allows you to catch yourself before making decisions driven by emotion rather than logic. The truth is, most investors don't fail because investing is too complicated. They fail because they approach it without structure, discipline, and self awareness. And those are the factors that actually determine success over time, not luck or secret strategy. And once you understand that, you can shift your focus from trying to beat the market in the short term to build a system that works for you in the long term. Because at the end of the day, successful investing isn't about doing something extraordinary. It's about consistently doing the right thing and avoiding the mistakes that cause most people to fall short. And if you can do that, you put yourself in a position where time and compounding start working in your favor instead of against you. Thanks for watching today's video. If you found value in today's video, please subscribe. Without you, I can't grow this channel, and I need the subscription base because YouTube says I gotta have it. And I plan on being here for a long time, so please subscribe. Also, comment down below. I respond to all positive comments, and if it's negative, don't waste my time and don't waste yours because I'm gonna block it. Thanks for watching. Also, check out this video to the right, and it will help you on your financial journey as well. Take care. We'll see you guys tomorrow.